All right. Things work.
Hello, everybody. My name is Denise Appleby. Thank you for joining me for final RMD regulations, focusing on key provisions. It's finally here, people. We've been waiting a long time. For this presentation, I'm just going to be focusing on some key provisions. There are a lot of things that we can cover from the final RMD regulations. And so I thought, why not just start with the hot topics, right? Those areas that have been getting so many questions on since Secure Act 1.0 was signed into law. And to that end, by the end of today's session, you're going to be able to explain what is the at least as rapidly rule and which beneficiary is subject to the 10-year rule, which beneficiaries qualify for the automatic waiver of the excise tax and RMD failures. And we're going to be looking at Roth accounts too, because I don't know if you noticed, but usually when we attend webinars about IRAs, like people forget Roth accounts. This is a little bit about me, a little bit of disclaimer. So like the kids are saying these days, this is how it started. On December 20th, 2019, we got Secure Act 1.0, and it included a lot of changes. Increased the required minimum, the age for starting required minimum distributions, gave us eligible designated beneficiaries, took away the stretch from everybody else. And so here we are because there were questions. So that's how it started. This is where we are. You should know who this is. I did this webinar already and some people knew. At last. If you don't know who this is, then look it up, right? So this is where we are right now. We have final regulations that were published on July 19, 2024, and pretty much explained what we need to do based on the changes that were made by Secure Act 1.0. Now, in the meantime, Secure Act 2.0 gave us a schedule of RMD starting age. So you remember once upon a time, you used to say to your client, they ask you, when do I start taking my RMDs? You would say, well, when do you reach age 70 and a half? Or when did you reach age 72? But now we have a schedule to follow. And this is important. Here's why this is important. It not only helps you to determine when your client must start taking required minimum distributions, but it helps you to determine if the account owner died before their required beginning date or not. And remember now, the distribution options that are available to a beneficiary, one of the determining factors is whether or not the account owner died before the required beginning date. So if you're having conversations with someone who's talking about their beneficiary IRA, you got to pull out this chart and find out whether or not the account owner died before their required beginning date. Now, I introduced one piece of music already. If you're under a certain age, you got to know who this is. We can talk about it offline. Bottom line is, Roth accounts are not like the rest. So as I go through this webinar, when I talk about the distribution options for primary beneficiaries, bear in mind that for Roth IRAs, the owner is always treated as if they died before their required beginning date. And effective for 2024, the same thing applies to designated Roth accounts, like your Roth 401ks, Roth 403bs, and governmental Roth 457b plans. Now, I'm emphasizing effective 2024 because if someone would reach their required their first RMD age in 2023, meaning they could have taken that RMD in 2024, that does not apply. They still have to take it. This new provision applies only to RMDs for 2024 and after. This makes sense to me, and I think you will agree, because I couldn't understand why the RMD rules apply to designated Roth accounts. I mean, eventually they're tax-free like Roth IRAs, right? And one of the benefits to the IRS of individuals taking required minimum distributions is so they get that tax, man. And there's no tax to get from Roth IRAs. There's no tax to get from designated Roth accounts either when distributions are qualified. So now, one of the strategies that financial advisors used to use is to tell their clients with designated Roth accounts, right before you reach your RMD age, roll over that designated Roth account to your Roth IRA. Why? So you don't have to take RMDs. Now we don't have to hurry and do that anymore. The 10-year rule is a lock. Don't ask me why, but this is the most popular provision that came out of Secure Act 1.0. And I think part of the reason is that it's because it's so confusing, right? Now, who caused that confusion? Not me, not you, the people who wrote the language for Secure Act 1.0. Now, you'll remember that when the language in Secure Act 1.0 pretty much said, remember that old 5-year rule where for the first 4 years, you don't have to do anything unless you want to, but you got to empty the account in year 5, right? No later than year 5. For the 10-year rule, they said, if you're a designated beneficiary, you're subject to the 10-year rule, and it's just like the 5-year rule. You don't have to do anything from year 1 through 9. You empty the account no later than year 10. And they went on to say, this shall apply whether or not distributions have begun. So in short, whether or not the account owner died before the required beginning date or not, RMDs were optional. It seemed black and white to me, and a lot of people agreed. Then the IRS published the proposed regulations on February 24th and said, hang on a second, Denise, you and your friends who are spreading this information, you're only half right. Because what you guys are forgetting is that the at least as rapidly rule applies. Like what? Well, I knew about the at least as rapidly rule, and I know you did too, but based on the language in Secure Act 1.0, it seemed clear that it did not apply here. But the proposed regulations explained that that provision was not repealed. What does this mean then? How does this affect those 10-year beneficiaries? It means that just like every other beneficiary, whether you're a non-designated beneficiary or an eligible designated beneficiary, if you inherited an IRA from someone who died on or after their required beginning date, you got to continue taking RMDs. You know, once you start that train, you can't stop it. Well, designated beneficiaries have to stop that train no later than the end of the 10-year period, but you get what I mean. Anyone who inherits an account from someone who died on or after the required beginning date, they're subject to the at least as rapidly rule. Now, pay no attention to the man in the window, because the at least as rapidly rule is a confusing term. If you are working with an account owner who was taking RMDs, which are calculated using the uniform lifetime table, by the way this is written, you're probably thinking, oh, they have to take RMDs at least based on that. That's not what it means, because what we got to remember is that for the beneficiary, the only table that can be used to calculate RMDs is the single life expectancy table. So probably what they should have said is, well, you got to continue taking RMDs, except that in your case, you're going to use a different table based on either your age or the age of the decedent, whichever is longer. So hopefully that clears it up. Here's what happened now. When the proposed regulations included that language, as you can imagine, there were a lot of people responding to the IRS, giving comments saying, you know, you are deceitful. You distracted us, and now you told us that we didn't have to take RMDs. And as a result of that information, Tom, Dick, and Harry didn't take any RMDs. What happens when someone doesn't take RMDs? They owe the IRS an excise tax. It used to be 50%. it's now reduced to 25% effective 2023. So here we are, we're 10-year beneficiaries, for whatever reason or not, who inherited an account from someone who died on or after the required beginning date, didn't take any RMDs, and now we're faced with the issue of these individuals having to pay the IRS a 50% or 25% excise tax. And so the IRS said, hang on a second, you're right. The language is, our explanation is correct, but it was misleading. And so what we're going to do is put a little Band-Aid on it, right? And they issued notice 2022-53 and said, we're going to give you an automatic waiver of that excise tax for 2021 and 2022. Come 2023, they still were not ready with the final regs, and so they put another Band-Aid on it. Come 2024, they put another Band-Aid on it. So now your clients who are subject to the 10-year rule and also are required to take annual RMDs get an automatic waiver. And the benefit of the automatic waiver is that there's no need to file IRS Form 5329. The IRS even went as far as to say, when they issued notice 2022-53, you know what? If you already paid the excise tax, just let us know and we'll send you your money back. So here is a common question that I get because people are confused. I get questions a lot saying, Denise, my client inherited an IRA from so-and-so. Do they get the waiver? Because some people believe that everyone gets the waiver, and it's not everyone that gets the waiver. So our job here is to identify who gets these automatic waivers. They have to meet two requirements. They have to be subject to the 10-year rule, and they must be required to take annual RMDs. Those are the only individuals that get the automatic waiver. And I think we've gotten to the point where everyone's almost clear now that this applies to designated beneficiaries. But guess who a lot of people forget about? Successor beneficiaries. If you are a successor beneficiary and you inherited an IRA from a primary beneficiary who was taking distributions over their full life expectancy, and you inherit that account after 2019, then like a designated beneficiary who inherited the account after 2019, you are subject to a 10-year maximum distribution period. And in that case, you would continue taking distributions over the primary beneficiary's life expectancy, but you got to empty the account no later than 10 years after the year in which the primary beneficiary died. Now, part of what the regulations explained is that this applies to eligible designated beneficiaries, their successor beneficiaries. So if you have an eligible designated beneficiary who inherited an IRA in 2022, they're taking distributions over their full life expectancy. If they die, their successor beneficiary must continue taking distributions over the eligible designated beneficiary's life expectancy, but they got to empty the account no later than 10 years after the year in which the eligible designated beneficiary died, right? They added another class of beneficiary to this class. Those are designated beneficiaries who inherited the retirement account before 2020. Because remember, those beneficiaries could have elected to take distributions over their full life expectancy. So those beneficiaries gets promoted to eligible designated beneficiaries. And if they die after 2019, then their beneficiary, who's a successor beneficiary, must continue taking distributions over their life expectancy and distribute the account no later than 10 years after the year of their death. Now, I know that everyone's focusing on the primary beneficiary, the designated beneficiary, but I think this is a big overlooked group. And you know why? Because designated beneficiaries, even though they got only a week warning, meaning 1 week, not weak versus strong, even though they got a warning of only 1 week to prepare, they were told, right? This is not about whether or not it's right. They were told. But you know who got the shock of their lives? Your clients who, when you met with them before 2020, you said to them, name your grandkid as your beneficiary. because then you can stretch the IRA pretty much forever. And so name your grandkids. My friend Ed Slott used to say, if it's a Roth, every time they get that check, they're going to like, ooh, my granddad left me a check. I get it every year and it's tax-free. So it makes them continue to love you more, right? But now you have to go back to these clients and say, you know, all those plans that I put in place for you before 2020, scratch that. Because if the beneficiary dies after 2019, that long life expectancy that I told you about has now been cut down to 10 years. So to me, this is a much harder conversation to have. Now, here's something that you want to bear in mind when we talk about that automatic waiver. Despite all the other headlines that you have seen, it is the excise tax that is waived, not the RMD. And that's an important distinction. Why is that? It really doesn't affect IRAs because you can't roll over distributions from an inherited IRA, right? Unless you're the surviving spouse. And the surviving spouse is not subject to the 10-year rule. So this really doesn't affect IRAs. But what we need to pay attention to is employer plans, because if someone inherited a 401k and they're subject to the 10-year rule and they took advantage of the waiver, so they didn't take that RMD, they can come to you now and say, I want to roll over my inherited 401k to my beneficiary IRA. They can do that, right? Because they are a designated beneficiary. Now, what you have to ask them is, well, did you take those RMDs? Because if you didn't, there is nothing that says you can roll it over, which means you got to take those RMDs before you roll them over, because the standing regulation is that you cannot roll over an RMD. Now, remember in 2020, when the IRS waived RMDs, compare it with that, right? When they waived RMDs, two things happened. The 5-year period was extended by 1 year because RMDs were waived for 2020. And individuals were able to roll over those amounts that would have otherwise been RMDs. So that's an important distinction to make when you're having that conversation with your client. Make sure that you find out, are we talking about an IRA or are we talking about a 401k or other employer plan? Now, you guys know who this is, right? You know, I've seen a couple episodes of this show where people ask her for certain things and she said, no, denied. So this is one of the provisions where commentators wrote to the IRS and say, listen, man, can't you just waive the A.L.A.R rule? And the IRS said, no, we don't have the authority because that's the law of the land. So we're denying your request. And as a result of that, because they did not waive RMDs for those years, because the A.L.A.R rule continues to apply, guess what? The 10-year rule is not extended, because remember, RMDs were not waived. So someone who inherits an IRA in 2020 and they are a designated beneficiary, they have to make sure that account is fully distributed no later than 2030 if they're a designated beneficiary, right? Another question that comes up often is, well, my client inherited an IRA in 2020. They didn't take the RMDs for 2021 to 2024. They are a designated beneficiary. Do they have to play catch up come 2025 when we have to start taking those RMDs? And the answer is no, they don't have to play catch up. But something that you want to bear in mind is that beneficiary only has about 6 years to fully distribute the account. And so now this becomes more than a question of, should I take my RMD? It becomes a question of, should I take more than my RMD? Because we're talking about taxes now, right? In most cases, this is a traditional account. I know some of you are thinking, right, what do you mean most cases? Because it could be a Roth account if we're talking about a successor beneficiary. But, you know, someone who inherits $5 million and has to fully distribute that amount over 6 years, depending on their tax profile, that could cause them to pay more income tax. So when you answer that question for a client, if you're not the tax advisor, you got to get the tax advisor involved to run the numbers and answer the question, should I be taking more than my RMD? And the answer is going to be driven by how it affects them from an income tax perspective. those are not the only beneficiaries that are subject to the 10-year rule. There are other 10-year beneficiaries. For instance, if an eligible designated beneficiary inherits the retirement account from someone who died before the required beginning date, they could be subject to the 10-year rule. Are they affected? No. Why? Because in that case, there's no annual RMD requirement. And in that case, they are an eligible designated beneficiary. They don't meet any of those requirements. Now we finally know what the beneficiary options are. And so we can speak with confidence when we talk to clients about what the distribution options are for that account that you inherit. And you've known from some of my past webinars that there's certain key questions that you have to ask a beneficiary to determine if the account owner died before 2020, if they are the primary beneficiary, and if they are the successor beneficiary. The successor beneficiary thing is so important to me because usually when I review an RMD calculation for a successor beneficiary, I would say about 100% of the time it's wrong because all parties involved assume that the successor beneficiary is the primary beneficiary. And so they're doing the calculation based on the assumption that that person is the primary beneficiary. So that's one of the questions that you got to ask them. Like I had a case where the taxpayer inherited the account, the beneficiary inherited the account from her husband. Right now you're thinking spouse beneficiary, right? But spouse beneficiary has a specific meaning when it comes on to distribution options. You have to be the spouse of the account owner. You can't be the spouse of a beneficiary. For this purpose, you're not married, right? You're just a regular designated beneficiary. Just an example of why you want to ask all the questions. Secure Act 1.0 added eligible designated beneficiaries as we have established. So now when you have the conversation with your client about what their distribution options are, you got to determine, are they a designated beneficiary? And if they are they an eligible designated beneficiary, which would be a designated beneficiary who's either the surviving spouse of the account owner, a child of the account owner who has not reached the age of 21. I emphasize child because no longer can you say name your grandkid as the beneficiary so they can be an eligible designated beneficiary. It has to be the child of the IRA owner. You got to be disabled or chronically ill or not more than 10 years younger than the account owner. And this status is determined of the time of death. Right now, you're probably thinking, what could change? Well, someone could inherit an account today and comes to see you and tell you they're disabled, and you automatically think, oh, you're disabled. You're an eligible designated beneficiary. But you got to take it further and say, hang on a second. When did you become disabled? When did the IRA owner die? Because if you became disabled after the date on which the account owner died, then you're not an eligible designated beneficiary for purposes of the RMD rules. And anyone who's not a designated beneficiary is a non-designated beneficiary, like an estate or a trust. And the successor beneficiary is someone who inherits the account from the primary beneficiary. The final regulations include a surprising change for see-through trust. I talked about the fact that to be a designated beneficiary, you have to be an individual. I think I said that. If I didn't, I meant to. So usually you have to be an individual. There's an exception if a trust is a qualified see-through trust. In that case, the beneficiary of the trust is treated as the beneficiary for purposes of determining if the trust is a designated beneficiary. Now, one of the requirements, in addition to these listed here, is that certain documentation has to be provided to the plan trustee or plan administrator or the IRA custodian. But don't tell anybody that I tell you this. But in my experience, a significant percentage of that documentation never got to the IRA custodian. So we have a lot of people out there walking around doing calculations for trusts that they think are see-through trust when they're not, because that documentation requirement was never met. But the good news is now the law of the land is for IRAs, you don't have to provide that documentation, which makes sense to me. But for qualified plan, it still has to be provided. Now, one of the things I notice here is a trend where some of the administrative responsibilities are being removed from IRA custodians, but they still remain with plan administrators. That seems practical because you're talking about sending in your documentation to a big box custodian with hundreds of employees where it could get lost in some big hole, or it goes to an employee that doesn't have the experience to review that documentation. Whereas typically with a qualified plan, it's usually a smaller group of people with a high level of expertise who are more likely to be trained to review those documentation and make an accurate determination. Here's another question that was answered. I talked about the fact that if a minor child of the account owner inherits an account, meaning under age 21, you remember proposed regulation says, we're not going to look at state law, just apply it at a federal level. You're under age 21, you're a minor child. Doesn't matter what state law says. But now the final regulations have taken it further and answered some of the questions that we've been asking. Well, who are child, stepchildren, adopted children, and certain eligible foster children? Now, be careful here, right? I'm from a community where we have a lot of kids who are living with people who are not their kids, right? Some kid keeps coming over because they like the food at the house and they never left. And the parents of the house say, oh, you can stay. I'll just tell your parents you're here. Now, they might love them. They might love them enough to name them as beneficiary of their IRA. Are they an eligible designated beneficiary as a result of being a minor? No, because they're not a stepchild, they're not legally adopted, and they're not an eligible foster child. So this is my summary sheet that I expand on for my clients. It's high level, and this is just sort of a jump off point for you to use when you're talking to your clients about what the distribution options are for a beneficiary. The most important one I want you to look at is in where the account owner dies on or after the required beginning date, and the beneficiary is an eligible designated beneficiary. Because in that case, there are two options, right? They can choose a 10-year rule, or they can choose the life expectancy rule. Some documents will default to either of the two. And so the question for you is, you're having a conversation with your client and you ask them the right question, you determine that they are an eligible designated beneficiary, and you automatically assume that they have the life expectancy option available. But you got to check the terms of the document to see whether or not it defaults to the 10-year rule, which is more likely to be the case with an employer plan, but sometimes apply to IRAs too. I've had cases where spouse beneficiaries were subject to the 5-year rule under the Pre-Secure Act rule. Spouse beneficiary gets a check for almost $10 million saying, here is your $10 million inherited account. Condolences on the death of your husband. And guess what? This is an RMD and you can't roll it over. Why? Because the plan defaulted to the 5-year rule. And now here we are in year 6. So here's a planning opportunity here for when you meet with your clients. Now, please send in your questions. I love to hear from you. I want this to be a conversation. This is just not me talking, right? This is us having a conversation. And I want to make sure that I answer the questions that your clients have been asking you. Now, for the 10-year rule, when the 10-year rule applies before, if the owner dies before the required beginning date, that's when we have distributions that are optional for the first 9 years, and the account has to be emptied by the end of year 10. You know, when people started making a fuss about, oh, no, we got to take annual RMDs, you know, I said to myself, hang on a second, shouldn't the question be, should your clients have been taking distributions anyway if it's a traditional account? Otherwise, you're going to have a big lump sum bunched up in year 10, which could impact them from an income tax perspective. And yeah, I know. I learned from one of my clients who's a savvy financial advisor. Hey, Julie, if you're on here. And she said to me, Denise, you know what? There's some benefits that are affected by income. And so in that case, it might help if the client doesn't take distributions that are included in income in certain year and wait till it's more beneficial for them to do so. And so the question for you as an advisor is, how do you advise your client when it's a traditional account? Because if it's a Roth account, you know, hey, let it sit there if you don't want it. Grow tax deferred. At the end of the 10-year period, everything's tax-free, penalty-free because it's due to death. You know, and let's have a party. We're rich now and we don't have to pay income taxes on it. But when it's a traditional account, the tax impact always have to be taken into consideration. Okay. Send me your questions. Love, love, love to hear from you. Notice the note at the bottom of this chart. We know that a minor child is an eligible designated beneficiary. We know that if you're an eligible designated beneficiary, you can take distributions over your full life expectancy. I like to say full because you know what? If you're a designated beneficiary, you inherit an account from someone who died after the required beginning date, you still take it over your life expectancy. But the full is not in there, right? But for an eligible designated beneficiary, it is. There's also a twist for a minor child, where when the minor child reaches the age of majority, their life expectancy or distribution period ends 10 years after that. Now, one of the things that I've been saying ever since Secure Act was published is that in this case, if the minor child inherits the account from someone who died before the required beginning date, and the minor child elects the life expectancy option, come age 21, they still have to take annual RMDs. I got a lot of pushback on that. I don't know why, but the final RMD regulations confirm that. And then, you know, think about my train analogy. Once you start those life expectancy distributions, they can't stop. So the minor child has to continue taking annual distributions after reaching age 21, has to empty the account no later than 10 years after reaching age 21. Remember the disability and chronically ill designated beneficiary status that I talked about a few minutes ago? One of the requirements is that certain documentation has to be provided to the plan administrator, or under the proposed RMD regulations, the IRA custodian as well, by October 31st, the year following the year of death. Now, this was important because you, like the old rules of the qualified see-through trust, you might be thinking, oh, this beneficiary is an eligible designated beneficiary. But if the documentation is not sent in, then that disqualifies them from being an eligible designated beneficiary. Except now for IRAs, that documentation requirement does not apply to IRAs. It continues to apply to employer plans. I like where they're going with this. If you have an IRA and you're disabled, that's your business. You want to keep it as private as possible. And that was one of the issues that came up during the comment period. And and the trend that I'm seeing here from the IRS is, do you know who's the administrator of your plan? If it's a 401k, then there's someone paid to administer your plan. If it's your IRA, you are the administrator, not your IRA custodian in most cases. And so you're the one who's responsible for making sure that you meet certain requirements. One of the big things that came out of this, one of the questions that I've been getting from my clients is, well, who's going to calculate all these RMDs? If it's an employer plan, the plan administrator does the calculation for both owners and participants. For IRAs, when the IRS introduced the rules for calculating RMDs for IRAs, they were intentional when they said to IRA custodians, you're responsible for sending an RMD notice that includes either the calculated amount or an offer to calculate the amount upon request for IRAs. That does not extend to beneficiary IRAs. And it makes sense because of the different factors that has to be taken into consideration to calculate RMDs for an inherited account. It's really unreasonable to expect an IRA custodian to know that unless they're going to design a system where they capture every single piece of information, of which there are many, that is necessary to calculate RMDs for beneficiary accounts. Now, this is one of the rules that they took back. You can see this man dancing because he's happy, because he was like, what? That wasn't right. Now it's right, and I'm happy. My friend Natalie Choate was one of those who wrote to the IRS and said, you're being ageist here now, and you got to fix this. Here's how it works. If an IRA owner dies on or after the required beginning date, distributions are taken over the life expectancy of the beneficiary or the decedent, whichever is longer. And the proposed regulation says, okay, if you're the older beneficiary, if you're older than the decedent, you can take distributions over the decedent's life expectancy. But when it reaches the year where your life expectancy would end, you got to empty the account. So they sort of gave it and take it back. They got a lot of pushback on that. And so they removed that provision. So now your clients can take distributions over the full life expectancy of the decedent if the beneficiary is older than the decedent. This is one of those questions that looks like we haven't been saying things right. I don't know. It wasn't that black and white in the regulations until now. Here's what I'm talking about. Someone inherits an account from an IRA owner who died on or after the required beginning date. Now, I know if you have attended any one of my sessions, you know one of the questions you got to ask is, did the IRA owner take their RMD for the year of death? Because if they didn't take it, then that has to be taken by the beneficiary and is included in the beneficiary's income. But what if there are multiple beneficiaries? One of the questions that often comes up is, well, now we have Sally, June, and Jane. Which one of them takes the RMD? Can one beneficiary take it, or must all of them take it? Now, based on the language in the proposed regulation, it suggests that they have to take it on a pro rata basis due to the separate accounting rule. But the final regulation says, you know what? If Sally takes enough that covers all of those RMDs, then nobody else has to take anymore because the RMD has been satisfied. And I know long ago, some professionals used to say that the IRS just wants to know they get the income tax that's due. They don't care who take it. And now here is confirmation that that is the case. So don't forget this. RMD for the year of death. Before the proposed regulations, the law of the land was if someone dies and didn't take their RMD for the year of death, the beneficiary has to take it. That still applies. But it also said, because that owner had to take it by the end of the year, then their beneficiary has to take it by the end of the year too. Now, you imagine, there are a lot of IRA owners who wait until the end of the year to take their RMD. We can talk about what the reasons are in one of my future webinars. But imagine you inherit an IRA and it's from your favorite uncle and you're so sad and it's December and it's Christmas and you must remember to take RMDs. What a stupid rule. What an unfair rule. And so now the rule is, okay, as long as you take it, by tax filing due date for the year in which the account owner died, or the end of the following calendar year, then there's an automatic waiver of that excise tax. That is a fair rule. So we are all glad for that. There, in the proposed regulations, there was a deadline for a spouse beneficiary to treat an inherited IRA as their own. The final RMD regulations eliminated that deadline. That was one of them that came as a surprise to us. But if your spouse beneficiary client elects to inherit an account from someone who died before the required beginning date and elected a 10-year rule, weren't taking RMDs, and decided to roll it over to their account, now we got to calculate a hypothetical RMD, because here we are under the rule that says you can't roll over an RMD. So there's an elaborate process by which you calculate a hypothetical RMD, and that amount has to be taken because it can't be included in the amount that is rolled over to the spouse's own IRA. Lots of good changes that came out of the final RMD regulations. Now, these are just highlights, right? I am going to be covering more. The future webinars are going to be more detailed. And one of the suggestions that I got from a previous webinar, which I had planned to do anyways, Denise, all of this is Greek to me. You got to include some case studies so that it translates in my mind. And of course, we're going to include case studies. My clients will tell you that's what I do for them. Now, the final RMD regulations I have already counted has to be broken down into more than 20 one-hour webinars if the objective is to make sure that the person who's attending the webinar walks away saying, this is clear as a pretty blue sky, and not this is clear as mud, right? So look for more to come from me on that. So here are some of the key takeaways now. One of the questions that I usually get is, well, Denise, these are proposed RMD regulations. Do we have to follow it? Well, yeah, that's the IRS's interpretation of Secure Act 1.0. I mean, what else are you going to do? And I would say to them, you remember the 2002 final regulations? Do you know what we were using before then? The 1987 proposed regulations. So we were going on and on and on using proposed regulations. That's not the first time. The at least as rapidly rule was never repealed. Remember, that's part of what they asked the IRS to, let's just be buddies. Let's make that go away and pretend like we never see it. And the IRS said no. Because remember, the IRS doesn't have the authority to do certain things. That's why we don't have a waiver of the RMDs, because the IRS doesn't have the authority to do that. The IRS does have the authority to waive the excise tax because that's their area. That's their responsibility. They can't change the laws. They can only explain the laws, right? And remember, the rules vary by beneficiary. So you have to find out who your beneficiary is, not just for the purpose of, well, what's your required minimum distribution obligation? But when your client wants to move their account from some advisor that's not as smart as you and as efficient as you, you got to find out, can they move it? And how do they move it? RMD shortfalls are subject to excise tax. Whenever I hear conversations about excise tax, the focus is usually on the IRA owner. But remember, beneficiaries are subject to RMDs too. And if they don't take their RMDs by the deadline, they are going to be subject to the excise tax. Now, we talked about the automatic waiver for beneficiaries who are subject to a combination of the 10-year rule and the life expectancy rule. For 2021 through to 2024, they don't have to do anything. That waiver is automatic. But in all other cases, they have to file Form 5329 to report the excise tax, whether it's to pay the excise tax or to request a waiver. Now, here's a secret between you and I. I have worked with CPAs on filing many RMD waiver requests, many, and the IRS have never denied us. Now, there was one time when a CPA came to me and said, Denise, I heard you in a webinar saying this can't happen. And here's a letter from the IRS saying they're denying my client's request. When I looked at the 5329 that they filled out, it was filled out wrong. And so we fixed it, we sent it in, and then everything was copacetic after that. Well, there was this one time just last year when my client, who's a CPA, got a letter from the IRS saying, we already did this for you in previous years. We are not doing it again because you're making a habit out of it. And he was like, but they never did that. So he picked up the phone, called the IRS, and you know what they said? It was some employee who wasn't familiar with what they were doing and sent out some letter that does not apply to the client. So that's my story to tell you, if you think your client missed their RMD deadline due to reasonable error, I'm doing the air quotes now, but you can't see it, but just imagine me doing the air quotes, reasonable error, then don't just have them pay the excise tax. Help them file Form 5329 and request a waiver of the excise tax. Now, some people will tell you that because there's a new correction window on the Secure Act 2.0, where if you correct the RMD shortfall timely, the 25% is reduced to 10%. The IRS is not going to waive the excise tax anymore. That's not true. The rules are still there in the Internal Revenue Code saying that the IRS will waive it if the deadline is missed due to reasonable error. So anybody tells you that again, tell them I said that we need to have a conversation, me, you, and them. Now, we have time for questions. I want to thank you for being here. I know that you were busy, especially with what's going on right now in the markets, and I really appreciate you coming here and taking the time with me. And so now I will take your questions. Let's see. Oh, this is a great question. Oh, hey, Paul. Yeah, Etta James. So that was that at last thing that I did. I can't sing, as you guys can probably tell, but hey, you know, gotta give Etta props. So yeah, that was Etta James at last. What is happening in those born in 1959? Excellent question. For those who were born in 1959, under Secure Act 2.0, they fell into two categories: those who with a starting age of 73, those with a starting age of 75. So, but the final regulations didn't address it, but the proposed regulations for Secure Act 2.0 says, for now, let's park them in the age 73 column. Assuming a spouse is the primary beneficiary, what is the best way to name high-earning children, minor grandchildren as secondary, tertiary beneficiaries to minimize overall taxes for the beneficiaries? I feel like you sort of half answer your question. My recommendation is get the CPA involved. Have them model different distribution options to see which one is more suitable for your client. Have them look at all the assets, because we're not just talking about higher IRAs now for a high net worth individual. We're talking about the house, the boat, and the vacation property in Jamaica. So how do you determine who gets what to minimize the amount of taxes that they're going to owe? That's a great question, and one that you want to get all the family members together, all data together, run the numbers with the CPA and see which one produces the least amount of income tax. Let me see here. How and when can a minor eligible designated beneficiary select either option? Usually for employer plans, they have procedures in place where the beneficiary selects the option. Now for a minor, you're going to have a guardian who's going to act on behalf of the minor. But usually the plan would have procedures in place for, and I've seen those. What I haven't seen for IRAs is how do you make that election? But then again, most cases with IRAs, it defaults to what the regulations default to, which is the life expectancy option. So if it's an IRA, have a conversation with the custodian, ask them, what is the default option? And don't just take their answer for it. Say, show me where it says so. Because sometimes they don't know and they just make up stuff because they want to get on to the next call to make their numbers look good. Yeah, I've been there. Well, I don't do that, but I've seen people do that. Why would anyone choose the 10-year rule when the same cash flow strategy can be accomplished with the life expectancy option without the consistency of payments that is required on the option 2? In a case like that, I would profile the client to find out which one is more suitable. With a Roth account, for instance, they may want to stretch the account for as long as possible because they're an eligible designated beneficiary instead of being subject to the 10-year rule. Because you're right, if you choose a life expectancy option, you can back into the 10-year rule, right? By taking the minimum amount that would have been required on the life expectancy option or more than the required minimum amount. So there's more flexibility there with choosing the life expectancy option. But remember, there are some beneficiaries who say, I don't want to sit here. This is free money. I'm going to take this money and I'm going to go to Dubai or some other exotic island and spend it. I don't care. So the question is, what's important to your beneficiary and how do you plan to meet their goals and objectives? It seems weird to me that a minor of an account of an individual who died before the required beginning date must take RMD starting the year following the year of death. But once the minor has reached a 21st birthday, those payments may stop at the option of the once minor beneficiary. Now, what the regulations say is that when the minor reaches age 21, they are no longer an eligible designated beneficiary. They are a designated beneficiary. One of the other confusing language, because it makes some people believe that in that case, we know they have 10-year, but it makes some people believe that during that 10-year period, distributions are optional. But I've been telling people, distributions are required. You got to continue. And that was confirmed in the final regulations. It's in the proposed regulations too, but it's not quite clear. No, it's in black and white. We have no question now as to whether or not annual RMDs must continue. The final and proposed regs mention treating the spouse as a deceased employee so that the spouse can use the uniform lifetime table instead of the single life expectancy table. Does that apply to only employer plans or does it apply to IRAs? Great question, Melinda, because I've seen the articles and I've seen the challenges. Now, based on how I read the regulations, these do not apply to IRAs. I fail to see how anyone would come to the conclusion that they apply to IRAs. Right? The language now that talks to this provision seems to me very intentional about using phrases like defined contribution plans, whereas in other places they would say the participant, right? Melinda, you can call me and we can talk about it. It seems like you're on my side of the fence, and I enjoy these conversations, so would love to talk about that with you. This may be an unrelated topic, but I had a client that received a 990T tax form with K1 in his IRA because he holds some partnership stock, and now he has to pay taxes if he did a distribution. Why is the IRS expecting him to pay tax pass-through partnership if his account is deferred? That is a long-standing requirement, Anna. If you have unrelated business income in your IRA, you have to pay unrelated business income tax if it's $1,000 or more. It might be $1,000, but there's $1,000. Either it's $1,000 or more than $1,000. And there's a special way to calculate this amount where once they have calculated that amount, the usual process is for the custodian to debit the amount from the client's IRA and reports it on a Form 990T. So, you know, we have seen the news with Peter Thiel's account and Mitt Romney's account, and everybody wants to get in on this because they think they can make a bag of money with these non-traditional investments. But that's part of what they have to think about. The fact that you are going to pay unrelated business income tax in most places. But in the end, though, you know, if the investment does well, it's still worth it. Client born in 1951 dies in 2023. Is his RBD 2025? Let me get out the calculator. So he was born in 1951. I'll get back to that later. I don't want to hold up the rest of the questions, but put it this way. If he dies in 2023, how old was he? All right, 2023 minus 1951. He was 72 in 2023. He does not have an RMD for 2023. He reaches age 73 in 2023. So this is his first RMD year, and he can take the RMD for this year by April 1 of next year. You are the best. Thank you, Heather. Heather's my buddy. We get up at 3 o'clock in the morning and talk about IRA and tax stuff. Weird girl. Slide 23. If the EDB only is an EDB only if they are younger, what about someone who's less than 10 years? Can they be an EDB? So you can be an EDB if you're older. You can be an EDB if you're not more than 10 years younger. If you don't meet the age requirement, you can also be an EDB if you're a minor child, chronically ill, or disabled. I hope that answers your question, Anil. If not, shoot me an email. Let me go to my email slide just to make sure. Let me see. Are RMDs required for inherited Roth accounts when the owner dies after 2019? It depends, right? So we're talking about, let's assume we're talking about a Roth IRA. Because if we're talking about a Roth 401k, you got to say, did they die in 2023 or 2024? Because, you know, that's a complicated answer now. But if we're talking about a Roth IRA, yes, the beneficiary is subject to required minimum distributions. The question becomes now, anonymous, what are the RMD obligations? We have to look at which class the beneficiary falls into. Are they a non-designated beneficiary? Because in that case, the 5-year rule applies. They don't have an RMD until year 5. Are they a designated beneficiary? They don't have an RMD until year 10. Before then, distributions are optional. But if they're an eligible designated beneficiary, they can choose the 10-year rule where we don't have any RMDs until year 10, or they can choose to take distributions over their single life expectancy, in which case they must take annual RMDs beginning the year following the year of death and continue for every year after until death or until their life expectancy expires. So yeah, that's a long way of saying absolutely. Remember when I said earlier, remember that slide where I said not like us, you know, where I said for Roth accounts, it's the same as traditional IRAs when the account owner dies before the required beginning date. These new regulations completely restate old regs. There's no reason to go back to the old ones unless reviewing pre-2020 issues. Yes, these new regulations are what you should use. And I would recommend not going back to the old regs. I'm going to have a follow-up class where I talk about that, because right now I'm in a conversation with a big box custodian who refuses to do right by my client because the account owner died before 2019. And, you know, it's just a long story, but just use the new regs. Don't go back to that old stuff. The regulations clarify whether a surviving spouse has to make an election to delay RMDs until the decedent would have reached the RMD age. It kind of sort of did. And remember, someone asked the question earlier about if it applies to employer plans or IRAs. I'm not even going to say it's my opinion. I'm writing an article right now where I'm saying, why are you saying this applies to IRA? It doesn't. And here's why it doesn't apply to IRAs. So yeah, the plan, for the spouse beneficiary, the plan defaults to the life expectancy option, but the plan can include a provision where the spouse beneficiary elects a 10-year rule. Slide 27, EDB has two choices, life expectancy or 10-year rule. If the default is 10 years, can the spouse roll over the IRA 401k to their own IRA and thus gets the stretch? Absolutely. Is there ever a situation where a successor beneficiary of an EDB has to use the remaining life expectancy of the EDB rather than their own? Well, the successor beneficiary never uses the successor beneficiary life expectancy. They don't matter, successor beneficiary. Like, for you, I don't want to know your date of birth because your date of birth don't matter. The only person's date of birth that matter is the primary beneficiary. I have your quick reference guide. How can I tell if it's updated for these changes? Paul, it's not updated yet, but you're going to get an updated version at no additional cost. Because remember, my promise to you is that when you buy the 2024 version, you get the 2024 version, including updates. And if you buy if someone buys the 2024 version now, they get the updates too, and they get 50% off of the 2025 version. Hey, Doug. Individual died at age 59 in 2024, traditional IRA. Brother, age 62, is a beneficiary. So right now we're seeing older, right? What does that mean? He's an eligible designated beneficiary. I take it, so let me read the question and not jump in there. Individual died at age 59 in 2024. Traditional IRA. Brother is age 62. I take it brother is subject to the 10-year rule. Would they be considered an EDB and be able to use the decedent's life expectancy, which is 28.0, or single life expectancy? I'm a bit confused. It's a lot of confusing stuff, Doug, but that's why you come to me, right? So in this case, where the IRA owner is 59, brother is 62, that's not more than 10 years younger. That makes brother an EDB. So you said, I take it brother is subject to the 10-year rule. Not necessarily, because remember, dying at age 59 means that they died before the required beginning date. And if they died before the required beginning date, 62-year-old brother can choose the 10-year rule or the life expectancy rule, or be subject to either of the two under the terms of the IRA agreement. Most default to the life expectancy rule. So it would not be the decedent's life expectancy that is used here, Doug, because you only use the decedent's life expectancy if the decedent died on or after the required beginning date. But for death before the required beginning date, it's only the beneficiary's life expectancy, right? Hope that answers your question. So they can choose 10-year life expectancy. And if they choose life expectancy, it's the life expectancy of the beneficiary, not the decedent. What happens if an EDB disclaims to a DB? 10-year rule. Yeah, because if you properly disclaim timely, you go poof. You're not there. You were never named as a beneficiary. So here we are. The designated beneficiary gets promoted to primary beneficiary. All right. The guidance includes the option for a look-through trust to pass to separate trust for each beneficiary, provided it is divided immediately upon death. Does it allow a separate accounting rule to apply? Yes, it does. Elizabeth, this is a good one. What does it mean for the spouse to be the sole beneficiary of a retirement account? Can they be the outright beneficiary of a separate share or main funding trust when the retirement benefits are allocated to the surviving spouse? Let me answer regularly first, because for trust, Elizabeth, if you could send me an email, because this is a longer answer, and I want to give you that longer answer. This sounds like lawyer stuff. I'm not a lawyer, by the way. But for a regular IRA, the spouse being the sole primary beneficiary means that they're the only beneficiary named on the account. Or by separate accounting, they become the sole beneficiary of their share. And that would allow them to choose the sole beneficial life expectancy option. Who can wait 10 years to take RMDs after decedent's death? A designated beneficiary who inherited a retirement account from someone who died before the required beginning date, or an eligible designated beneficiary who inherited a retirement account from someone who died before the required beginning date, and they are subject to the 10-year rule as opposed to the life expectancy rule. Is it only distributions weren't taken by the decedent and the beneficiary? Is it only if distributions weren't taken by the decedent and the beneficiary is an EDB? Doug, I'm not sure what that means. If you could resubmit your questions, please. Will a replay be available on your website? It will be on my YouTube channel. There will be a link on my website, so make sure you follow me on YouTube, please. Thanks, Melinda. Look forward to your call. Slide 23 may need to be corrected for up to 10-year older EDB. No, if it's an EDB, there's no 10-year rule, right? If there's an EDB, there's no 10-year rule. But I'll have my assistant pull up slide 23. My assistant is me. So I'll look at that, but thank you. I appreciate all your questions and your feedback. So anything and all, just throw it over here. Thanks, Denise. I have a call. Hey, Marka. Thanks for being on. Thank you, Denise. Hey, Mike. Thanks. Great information. We'll be making the recording of this webcast available. Lots of great information. Thank you all for your feedback. Please, if you think I didn't answer your question, please email me. Just remind me that you attended this webinar, because I charge to answer questions. But if you tell me that you attended this webinar and say, Denise, I asked a question and you didn't answer, or something like that, then I won't charge you for that. Just, that's pretty much it. I think I got all the questions. If I didn't, I'll email you with your questions, but you guys have been great. Thank you very much for taking the time to be here with me. I appreciate you so much. Enjoy the rest of your day. I appreciate what you do. Bye, everybody.